Where we're going to start here is with number 3. Number 3 has one little new thing that we didn't talk about in the lecture, and that's when a company charges you a service fee to use their credit card. So think of this as kind of like Visa or MasterCard, something like that. You can do this one of 2 ways. You can show that you have an account receivable for MasterCard or Visa. In some, it's so much so guaranteed, and you pretty much have almost instant access to it. You could call it cash as well. It's just basically cash, kind of like going almost into your bank account. That's what the book's going to do. Even though the customer uses their credit card and we don't maybe have access to the fees immediately, we're going to have them really, really soon. And we're going to count that as cash when we're doing this. So what we're going to be doing is doing one entry, and we're going to show that we're getting cash less the amount of fee that they charge that company for allowing that almost immediate access to cash, and that we don't have to collect it then from our customer. It's the SunTrust bank card. They're going to have to go after the customer to get the money. And that makes it a lot better, and that's why companies take credit cards. They don't have to track you down. They get the money almost immediately from Visa, and then Visa tracks you down if you don't pay. So with this one, we sold merchandise for $8,400. It cost us $6,000 to get it, and we did it with the SunTrust Bank. They charge a 4% fee. So we come down here, and we sold the merchandise for $8,500. And remember, I said that we can, in the book, they're going to count this when we get the credit card. When they give us the credit card, we're going to say that's pretty much the same as cash. We have almost immediate access to it. So what we're going to do is say, okay, out of the $8,400, we're going to collect 96% of that, because the first 4% goes to SunTrust as a convenience fee for us, as a thank you for giving us the upfront money and you doing the work of collecting on it. So what I'm going to do is simply just take this by 96% and show that we are getting $8,064 out of that initial $8,400. That the rest of it, the difference between what we brought in sales versus what we're getting, that $336, that's considered that service fee charge. So let's look at the expense. They call it a credit card expense. Makes sense. And then simply, we're going to show that we made a sale, and our sale is for the entire $8,400. We didn't collect all $8,400. That's because some of it went here as an expense. But you always use expenses as that's just one of the ways of doing business. That's one way of getting our $8,400. We had to pay a little bit to get it. So we're going to record that entry. And then remember, as we did in our past couple chapters, whenever we make a sale of goods, we always have 2 entries: the sale and then getting rid of the inventory at what it cost us. So this one's very easy. They just tell us what it is. Cost of goods sold, $6,000, and then get rid of the merchandise inventory for $6,000 and record the entry. We'll do it one more time here. We have, for using the other company's credit card, they have a 2.5% fee. You can think a lot of companies do this. If you have ever worked in your own small business or with somebody else's small business, they may have used something called a Square. If you've ever seen the Square, that's a company. They collect, basically what that means is a customer can pay you using a credit card. It goes through Square. Square then pays you the difference minus their cut. And that's kind of the same thing that's going on here. So we've got a 2.5% service fee. So we're going to take $5,600, multiply by, take 100% minus the 2.5%. So 97.5% I get to keep. So that's $5,460 of cash. Credit card expense for the difference, the $5,600, so that's $140. And then simply that we had a sale of $5,600. And then the final entry showing the cost of goods sold. And they tell us, so there's It's not difficult here. Just simply debit 3,500 cost of goods sold, credit merchandise inventory for 3,500. Okay, so check the work to make sure it looks good. And yeah, we got all check marks. Okay, on this one's just a tiny bit different in that this one, the company has their own credit card. So think of it like Kohl's. If you go shopping and you use your Kohl's charge, Kohl's is acting as the credit card, and they're going to be coming after you if you don't pay it. So that's the main difference with this one. With this one, we're actually going to debit our account receivable for this customer, whoever it is, they don't tell us, for the $1,000, and simply record it as a sale. Yep, as a sale. The 1,000, and then we're going to do part 2, the cost of goods sold. They tell us exactly what it is, $650. So notice with this one, we didn't charge a bank expense account, or we just planted all 1,000 as an account receivable, because we are acting as the credit card, our own credit card company. And then the difference is, since we didn't get the money right away, and some interest was earned, it says $4 of interest was earned on this bill for the end of the month that we didn't pay off, say, our Kohl's account. So all we're going to do here is just show that we're going to add in interest receivable for $4. We didn't even need to calculate it. That's going to come later. And we're going to debit our interest revenue for the $4. We probably wanted you to. Number 5, this goes back to what we did in our notes. This is the first one, the direct write-off, the absolute easiest one. And then they go down, the percentage of sales is still easy. And then we had the AR, aging of account receivable, which is a little bit more harder, a little harder one, but a little more accurate. But for this one, the direct write-off, very simple. We're just going to take whatever the customer owes that we know they're not going to pay, write it right off to bad debt, take it right off the customer's bill. And then if we have to reverse it later because they pay us, that's what we do. So let's see how that works. Dexter determines that it will not collect $45,000 from its customer. Okay, so when we write off the account, we just simply go down to bad debt expense for 45 grand and take it right off the account receivable for the Lear company for 45 grand. Now what happens is on the 29th, after we've already written it off, the company actually pays off their debt. We're happy that they did it. We're not going to turn down the money. So what we need to do is we need to go back and basically whatever this entry was and reverse it, because it never really happened. They actually paid us. So we need to put the account receivable back on the books and credit that bad debt, pretend like that account never happened. So we're going to debit 45,000, and this is one of the only times that we can ever credit an expense, is if we have to undo it. And then we're going to, that entry that we just did before is now basically canceled. We're back to 0. We're back to account receivable being at 45,000. So now we're going to show that we got cash for 45 grand and took it again right back off the account of Lear company. They don't owe us. They didn't owe us before because we took it off their account, but now they don't owe us because they actually paid me. So that's a fairly easy one. Just showing that you had bad debt, undoing the bad debt because they finally paid you, even though you didn't expect it, and then showing the actual, all the way back to week 1, the entry to show cash coming in. Okay, so that's the absolute easiest one. This one is just the next step. It's showing that we don't know exactly who isn't going to pay us, but we suspect somebody isn't going to. And they estimate here that bad debt is 0.5% of sales. So a pretty small number, which is good. They already have 580 in uncollectible. Remember on that one though, that's not really needed for this example. When we do percent of sales, when a company chooses that method, It's not quite as accurate in my opinion, but when they do, this isn't really necessary at the time to do the journal entry. So all we're going to do to record the bad debt is the take 975,000 times by 0.05. That's 5%. This is actually 0.5%. Oops, that's too much. 0.005. That tells me that 4,875 is not going to be collected. I don't need to worry about the opening balance of 580, not on this one. That's what makes this one a little easier. So I'm going to do bad debt expense of 4,875, and I'm going to come down here and credit my allowance for doubtful accounts for 4,875. That's all I needed to do. And then it says here on June 5th, the company unexpectedly pays off their previously written amount. All I'm going to do is we wrote off Parks account. Oh, I see what we're doing here. So now we're going to go ahead and write off the Parks account as uncollectible. So this is what we did at the end of last year. This was just our guess. Now we have determined that this company, for whatever reason, P Park isn't going to pay me at all. We decide that the 580 account of P Park is uncollectible and writes it off as bad debt. Now I don't want to debit bad debt expense again because I've already done that. I did that back up here when we made this estimate. So what I want to do is come down here and take away from allowance because it's no longer unknown, $580, and credit the account receivable for Park. And then for 3 and 4, it's going to say that, oh, they paid us now. So when they pay us, we've got to undo this entry, just like we did on number 5, but we're just going to undo this one. We're going to debit AR credit allowance to make it act like it never happened, and then show that cash was received for the 580. I'm not going to go through that since we just did that. We'll just look at the first 2 answers, and there we have them. They are complete. Now number 7, okay, number 7 is kind of working our way up to the aging of account receivable, and it's using, they have to give us these, because when we're doing the aging of account receivable, we have to know the beginning balance where we started, and then we're going to figure out where we're at the end, and then the middle, how we got there, that's going to be our journal entry. So this, what we're going to be doing now, is you can see the percent of account receivable. That's the next one down. Or I call it percent. They call it percent. It's aging of account receivable. Kind of the same. They use the same format. So what I'm going to do is actually, let's go to the next one, because this one is actually we're going to calculate it, and I wanted to show how that works. So what we're going to be doing is, just like in my example, they give us, here's 570,000 of AR, and then that 570, if you would add up all of these amounts, it equals 570. And then they're saying, okay, the amount due, here's how much it's going to be that we don't expect to collect. So we're going to come down here and complete the table. It's pretty simple. It's just basically putting in these same numbers and then doing the math. So it says here 0 days, 396 and 1%. 396 at 1%, and it calculated it for us. We didn't even need to do it. So this is kind of just a copy and paste basically. So 90,000 and 2%. 90,000 is 1 to 10, 30 days late. 2%. 36 and 5. And then we got 18 and 7. And then finally, our last 30,000 at 10%. Okay, let's see what this look at here. What is that balance? That is going to be our credit balance. That's for the allowance for doubtful accounts. All right, so that's where we want to end up, 11,820. It's telling us here in part B that we are starting out with 3,600 as a starting balance. We want to end up at 11,820. So what we have to do is find the difference. 11,820 minus the 3,600 that we already started out at. So we need to tack on an additional $8,220. So that's going to be our journal entry here as we do bad debt expense for 8,220 and credit the allowance for doubtful accounts for 8,220. And that's simply all we've got to do for that first part. Now the second part, this one makes it just a tiny bit more difficult because this one, we've got to notice here that the balance is a $100 on the negative side. It's basically saying we didn't take off enough last time. We have, instead of a balance on the positive side where we still expect people not to collect, how much we still have not to collect, we actually have 100 on the negative side. So that means we didn't expense enough last time. So if we didn't expense enough last time, we've got to tack that extra 100 back on, plus the new stuff that we are at. Remember, the new stuff is, let's go back to it. Oh, here it's in my calculator still, but 11,820. Not only do I need to debit the whole 11,820 because I don't have a balance, I actually have a negative balance of 100. So I'm going to tack on an extra 100, and I'm going to put on 11,920 as my let's go here. 11,920 is going to be my debit. So you got to pay real careful attention to what it says if it's a debit or a credit balance. If it's an allowance for doubtful accounts, it's contra. So therefore a debit means it's a negative because it's an asset in the asset category. So we've got the bad debt expense for the 11,920. And we're going to credit our allowance for doubtful accounts because we want to get it up to 11,000.